Good morning and welcome this morning to Long Verticals and Diagonals, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm jumping in today to talk about a topic that is really kind of interesting. We've talked about this over the course of the last couple of weeks in this discussion, and today is no exception. The market is moving, so we've got a little bit to talk about. My good friend Brent Moore's out there in the chat today, 20-plus year veteran of the financial markets, there to help facilitate your questions along the way. Thanks to you for being here, whether you're in the recorded version or the live version. If you're in the recorded version, leave us a comment in the comment section. If you're here in the live version, participate in the conversation and ask some questions. Brent will answer those. I'll try to incorporate them into the discussion as well. And again, we're glad to have you with us. So let's jump in and talk a little bit about what's going on. We talked short term last week. I did a 1 day till expiration long vertical spread last week. I was going to go out to the other end of the curve this week. We'll see what that looks like. And I also want to talk about the idea of shifting a long vertical into a long diagonal and see what that looks like and what that entails as well. So we've got a couple of examples that we want to look at. We also want to look at what's going on in the market as a whole. But a couple of quick housekeeping items before we get started with all of that. Remember that everything we talk about is simply for illustrative and educational purposes only. None of these symbols or strategies or anything else are recommendations or endorsement or advice or anything like that. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies, including the ones that we're talking about, will involve multiple transaction costs. Also, remember that spread trading must, in most cases, be done in a margin account. If you have questions about that, please get in touch with Schwab or get in touch with your financial consultant. Great opportunity to initiate that conversation. Also, we're going to be using technical analysis in this discussion. Technical analysis is only one way of looking at the market. There are others. They're all theoretical in nature. None of those guarantees as to what is going to happen. We're going to be using the Thinkorswim desktop software platform, specifically the paper money version. Remember, the paper money version doesn't do certain things that the live trading account does, including the early assignment of short options. So that may become important as you move your practice from paper trading to live trading. Be aware of that. Remember that investing involves risk, including the loss of principal. And as we get into these discussions, again, remember that past performance of any security strategy does not guarantee future results or success. So let's do this. Kind of get an agenda here. We're going to talk about long vertical and diagonal spreads. We're going to talk about the impact, as we always do, of price, time, and volatility. Those are the three influences. I know that my good friend Brent Morris, who's out there in the chat, who has been a frequent contributor to a show that I host on the Schwab Network called Your First Trade. Now, first of all, the Schwab Network is brought to us by our media affiliate, Charles Schwab Media Productions, which is a separate but affiliated company. They're not a broker-dealer. They are not in the business of transacting financial transactions. They are simply a media production company. But the show that I host on the Charles Schwab Network is called Your First Trade. And one of the things that we did in the second season is we talked about your first advanced options trade. And we began that conversation with the idea of long vertical spreads. And I know Brent was a frequent contributor during those discussions where we talked about the influences of price, time, and volatility. Brent has also gone on because Brent teaches a webcast on advanced option strategies, of which long verticals kind of fall, where he talks about the influence of option Greeks on long vertical spreads or on vertical spreads in general. So if you want to delve deeper into some of those discussions, you've got a great resource out there in the chat. And you can also follow me. You can follow Brent on X. I'm at Ben Watson CS. Brent is at Brent Moores CS. And we can have some of those conversations as well. So thank you for participating in those discussions. So let's do this. Let's jump over here to the Thinkorswim desktop software platform. Again, good opportunity for me to remind you to click on that subscribe button down there at the bottom of the page. That's going to keep you connected to the Trader Talks webcast channel. It's at no cost to you. Also, if you click on the like button, that helps to pop this conversation up and the content up to the top of the algorithm. So it helps you out, it helps us out, and it helps other people out as well. So we can be helpful all the way around. And yes, I know that some of you already know all of this, and when it comes to YouTube, but some of you don't. Some of you are new to the ecosystem, which is fine too. And we're glad to have you here as well. We just wanted to share a little bit of that context. So let's take a look at what's going on in the S&P 500 right now. I talked this morning in our Trader Talks in today's market webcast about what was going on, and we were seeing this kind of initial neutral movement today, and we're kind of seeing this as maybe the byproduct of yesterday's big down move, right? One of the bigger down moves that we've seen really since back here in the end of April. We haven't really had as big or as substantial downward moving candle. Yeah, we've seen a little bit of a down move. We saw some big moves to the upside, but today was a little bit, or yesterday was a little bit of a down move. So today may be a little bit of a relief kind of pause. We're seeing that on the SPX. We're seeing a little bit more bullish movement on the NASDAQ. We're seeing a little bit less of a relief pause on the Russell 2000, but yet still some neutral movement. And so that kind of brings me to one of the characteristics of vertical spreads in general and long vertical spreads in specific. And when we get into some of these discussions, you're going to hear me talk about, and you'll hear Brent talk about this as well, the idea that long vertical spreads generally, depending on how we construct them, but to make them generally beneficial from a risk to reward standpoint, they're going to require some price movement. So if the overall market is not really moving very much and it's pretty quiet, and we take a look at volatility, come back over here to our VIX grid and take a look at what volatility is doing. Volatility kind of spiked yesterday with that little bit of a down move. It's kind of sitting up here in this 20 handle. It was in the 15 handle or in the 18 handle yesterday. So there's the potential that we get this little bit of a bleed off in implied volatility. So volatility moving against us. So what that suggests to me is, one, we have not a lot of directional movement, which kind of works against long vertical spreads. And two, we have higher and falling implied volatility, which generally kind of works against long vertical spreads. So we got a couple of influences, price and volatility, that we have to pay attention to that are kind of going against us. Now, that what that means then is we've got potentially the benefit of time. So if directionality and volatility aren't working in our favor, maybe we can create this this idea of a time-based spread. Now, Chuck asks a great question here as we're getting into this. When we draw levels of support and resistance, do you put the line on top? When do you put it on the bottom of the shelf? And I'll tell you what, I mean, you think about this from this standpoint, and I like that idea. Let's go back to our index grid here, because I think this is an interesting conversation. Let's go back to our index grid. And we go back to, say, for instance, some of these where I have drawn some lines, like on the Russell 2000. And generally, I'm going to draw a line of resistance on the top of a range when price has been moving up and it's turned and come back down. And that's going to be a determining factor of where I put that line of resistance. If price has come down and it's turned around and gone back up, that's where I'm going to put a level of support. And I can see that level there. So you kind of draw to where your directional perspective is. So good question to ask, Chuck, and as we kind of set up our expectations here. So let's do this. I want to kind of come out of the gate here really quickly with a trade. And one of those trades is one that I talked about this morning on the Schwab Network in the Morning Movers show. And I want to pop this up here really quickly into my single grid. Now, my single grid is just my kind of playground or sandbox for looking at charts, right? And so this is a stock that I talked about this morning. It's a stock that has been generally moving in a pretty strong uptrend, starting to see maybe this little bit of a pause into an ascending triangle. So there's some bullishness to it. But that's kind of one of the ideas behind a long diagonal spread is you're playing the longer term trend, but taking advantage of opportunities where the price of the stock is maybe pausing to bring in premium, much like a covered call, for instance, right? So a covered call would entail the ownership of the underlying stock and then selling call options against that ownership of the underlying stock, against those shares of the underlying stock. So we're going to create something similar here in a position on AT&T. Now, I don't own shares of AT&T in this particular account, but what we're going to create is we're going to create roughly the synthetic of, or an equivalent of, an analog to a covered call trade, because instead of buying the shares to provide the cover for the short position, we're going to buy a long option. So what I'm going to do here really quickly, and I'm going to pop into my Flask icon here. I'm going to change my RSI, which is the indicator that I had on there, and I'm going to put on here IMP, implied volatility. So we're going to put in here implied volatility. And implied volatility, again, remember, is reflective of supply and demand for options. So we look at where implied volatility is, and this has been roughly echoing what the VIX has been doing. It's relatively low, but it's starting to rise. And with it being relatively low, the next area that it might go is higher. Now, we're past an earnings announcement. The next earnings announcement is going to be a little bit over the horizon. We can see that generally implied volatility rises as we go into earnings announcements. That's the comparison here that we typically tend to see that relationship. But you're absolutely right, Vic. Vic says, didn't we see a divergence between price and RSI? Yeah. My premise, let me grab my magic marker. My premise in creating a long diagonal spread in this particular case is that my expectation is that the longer term trend is going to continue, but that we've got a little bit of a pause going on sideways with this squeeze happening. So what we were seeing with RSI, that sentiment indicator, was a bit of a divergence. This price is moving sideways. Pressure to the upside is falling off a little bit. That doesn't necessarily mean that this is going to reverse and move to the downside. In fact, what I suspect, given the fact that this is a longer term trend and my expectation here, my bias is still bullish. But I want to take advantage of being able to get into the longer term trend, right? Into this longer term trend and take advantage of that upward movement. But I want to do it in a little bit more efficient fashion. Again, the same reason why we might sell a covered call. So we're going to put together this trade here really quickly, and I'll kind of walk through the expectation. And then, Janice, I'll come back and I'll explain what those lines were. This blue line right down here is implied volatility currently. I think the ones you're referring to were moving averages on the index chart. So we'll come back to that in just a second. But what I'm going to do is I'm going to pop over here to the trade tab for AT&T. And what I noticed in this particular case for AT&T is that I've got some weekly options. Those are options that expire on a Friday that's not the third Friday of the month. No other real mechanical difference other than that they have a different Friday that they expire on. And then I've got some longer dated options out over the horizon. In fact, I've got some that would be considered technically to be LEAPS options, long-term equity anticipation securities. Generally, those are going to be the ones that are expiring in January or beyond. So anywhere from 180 days out, even beyond that. We've got some that expire 603 days out. That's probably a little bit long because I know that the market could move and could be significantly different 603 days out from where we are. So what I'm going to do is I'm going to go to this one right here. And I'm going to go to the 16 January expiration, and we're going to open up this option chain here. And we're going way, way out, right, in time, right? And so George says, yeah, the implied volatility percentile, or the current implied volatility percentile here, is the 22nd percentile. Implied volatility generally pretty low. That would suggest buying strategies, right? And so this is this long vertical spread that we're doing here, this long call vertical spread, is at its heart a buying strategy. It's going to be a debit trade. It's going to benefit from rising implied volatility. It's also going to benefit from the price of the stock moving higher. Those are the two conditions that really kind of work in favor of this. So what I'm going to look at is I'm going to look at an option that is really going to see a very, very slow rate of theta, right? Because I don't want time to eat away at the long leg because I'm paying for that one. But I do want time decay to eat away at the short leg because I'm collecting the premium on that one. And you notice the theta number for these options that are out 239 days to go until expiration. Those theta numbers are 0. So very, very, very slow. Theoretically, it's 0. It's not quite 0, but we only show options at a 2 decimal places, right? So if we were to extend those decimal places out, you'd probably see some increment of theta here, time decay, or the sensitivity to the passage of time, but it's effectively 0. So these long legs, if we were to buy these, if we were to buy this call option, it's not decaying away very quickly. Now, it will start to decay away more rapidly as it gets closer to expiration. But for the moment, it's kind of sitting there. So what I'm going to think about doing here is buying an option. And just like we do in terms of a long vertical spread, I talked kind of a little bit about this idea last week, is that we want to think about buying where the price of the stock is now and selling the short leg where we think the price of the stock is going. So I'm going to actually, in fact, kind of look right here at this, the price of the stock's currently sitting at about 27. I'm going to look at that 27 strike, and I'm actually, in this case, going to go one strike in a little bit. And the reason for doing that, going that one strike in, is I'm buying a little bit more intrinsic value. I'm buying something that has a little bit more value. Now, this far out in time, if my expectation were bullish, I could save a little bit of cash in terms of buying this long leg by buying a little bit further out of the money. But that has a lower probability of being in the money at expiration. And it means that the price has to be that much more directional in order for this trade to work. Plus, it's going to put my short leg, to create this as a long vertical, further out of the money, which means I'm going to collect a little bit less premium. So I'm going to buy, in fact, in this case, not the 27 strike. I'm going to go down to the 26 strike, just one strike in the money here. And we're going to look at buying that 26 strike call option. Okay, so I'm going to click on that one, and we're going to buy that one. If I were to just leave it as it is, that has infinite, absolute, maximum profit, right? Theoretical maximum profit. But the reality is, even 260 some odd days out till expiration doesn't mean that AT&T is going to go to infinity. So that's theoretical, obviously. But it's going to be relatively expensive. I mean, relative to the cost of the stock. The stock's $27 a share. So we're buying a contract here for $3.25 times 100 shares. But we're going to not stop there at this particular point. We've got that part of the order in, right? Bid-ask spread, even that far out in time, is pretty narrow, relatively, right? So it's about 10 cents wide bid-ask spread. So these are pretty liquid still. And now what I'm going to do is I'm going to come back to my option chain, and I'm going to come back to the shorter end of the chain. And I'm going to look at, say, for instance, 22 to maybe 15 days to go until expiration, right? And I'm going to say, look, I want to sell this option. I want to sell this premium where I think the stock is going to be within kind of that time frame. And where we find that information is over on the right-hand side, right? So go over to the right-hand side. We look at implied volatility, and we can see where that expected move is calculated. That expected move calculated based on implied volatility. And it's just simply saying, look, this is what the options market is pricing in, is that expected move. So I'm going to call that about a $1.40 move, either up or down in 22 days. So what this gives me the opportunity to do is offset a little bit of the cost of that long leg. That long leg was $3.25, right? So if I open up this 13 June expiration, and I expect that the price of the stock is going to move about $1.50, I'm going to actually detune that a little bit. The stock's currently sitting at about 27.5. So I'm going to go to either the 28 or the 29 strike. And in fact, I'm not getting a lot in that 29 strike. I'm getting about 16 cents. Not a lot of premium, right? But what I can do is I can go to this 28 strike, because remember, now I've got the 26 strike. I'm not right at the money strike. So if I were to sell the 28 strike, that gives me about, well, I mean, that's within that range of movement. It might also even lead me to come back a little bit in terms of my time frame and come to a little bit shorter time frame. And if I'm going to go to the 28 strike, I might look at selling that 28 strike with a little bit shorter time frame and give me another rolling opportunity. But I'm going to go back to that 22 days to go until expiration. We're going to look at selling that 28 strike in this particular case. We've already created the order, the part of the order to buy the long leg. I'm going to hold my control key down, and I'm going to left click on the bid price for that 28 strike. And now what I've created is a 26 strike, 28 strike, long call diagonal. And I've done it for a net debit, not of $3.25, but a net debit of $2.76. So let's do this really quickly here. Let's right click and let's send this to the Analyze tab, and we can kind of see what this then looks like in this particular case. So I'm going to take a look at this diagonal spread. And here's the challenge in creating these long-legged, kind of long expiry diagonals. This is a scenario where if we were to look at taking this trade off, or if the price of the stock makes a big move to the upside, we could get into a position, because if the price of the stock were to go above that 28 strike, or even above, in this case, my break even, which is right here at about 30, where we're kind of getting into a loss. Now, the challenge is this, because a long vertical spread, a long diagonal spread, if we are assigned early on the short leg in a long vertical spread, that could put us into our maximum theoretical gain. If we're in a long diagonal and we get a move, big move up, and then we're assigned early, that could put us into a position where maybe we're not seeing that theoretical maximum gain. So we could get into a position where it makes the move that we want it to make, and we take a loss. So we've got to be cautious in this case. And from a trading perspective, that's why this is kind of the first iteration of this trade. And I don't really want to see, and again, this goes back to why I was looking at that RSI divergence. I don't really want to see a big move to the upside. Although if I did, there are things I can do about that to free up that long option. So my expectation is, if the price of the stock makes a modest move to the upside, great. I'll buy back that short leg close to expiration, roll it, and sell another one. And I'm eating away at that premium that I paid for the long leg. And I'm creating this diagonal spread and allowing it to continue to follow that trend. The idea being, I want that long leg, the one that we bought out here for the 16 Jan expiration, I want that to continue to get as expensive as possible, because I want to be able to sell that back for more than I paid for it. And not only do I want that to get it more expensive, but I want this one, the one that I sold, to get as cheap as possible, as quickly as possible. So if we go back to our trade tab and we look at this one, the 13 June, and we look at a couple of things. We're selling the 28 strike. That's this one right here. It's decaying away more rapidly than the long leg. And if implied volatility goes up, that's not really doing all that much to raise the price of this short leg. But if we go back to the long one that we sold, look at our theta or our vega component on this 26 strike. If implied volatility goes up, that long leg is going to be adding about 8 cents per percent of implied volatility, whereas the short leg is only adding about 3 cents. So a rise in implied volatility is definitely going to benefit this long diagonal spread in this particular case. And here's the other thing to think about. This still gives me a lot of flexibility, because if the stock makes a big move to the upside, what could I do? I could simply buy back that short leg and sell another one. Or I could buy back that short leg and let the long leg continue to run, right? So this gives us a lot of potential gain, right? So Vic did the numbers here, right? If the stock goes above 28, you may get called out with that, $2 potential gain, right? A theoretical total gain of $2.45 could be a loss against the initial cost. So we're looking at paying $2.76 for this trade. It gives us some flexibility, and it allows potentially, in this case, to track that. And again, remember, this is an illustrative and educational example, right? This is not any kind of a recommendation. Now, the other thing that we could do, if we wanted to think about it in terms of increasing that, that kind of potential maximum gain, is we could change the duration on the one that we sold. We could sell this a little bit further out in time and bring in a little bit more premium. If we open up our lock here, we can see that we're bringing in a little bit more premium. We could even sell a little bit higher. And you can see that gives us so we're now selling out to the 27 June, and we're selling the 29 strike. And that gives us a little bit more room to work with if the price of the stock goes up, but it doesn't give us as many rolling opportunities. So this can be tailored to what we want it to accomplish. So I'm going to roll this back to the 28, and we're going to bring this back to our 13 June expiration. This is the range of gain that we're looking for, is kind of right in that particular area. And so I'm going to right click, and I'm going to click on confirm and send. We're going to read through this order, make sure that this is what we want to have happen. I'm going to put this in my vertical spreads group right there, and we're going to click on send, and we're going to fire that order off. We got that diagonal spread for $2.76, and we'll see what that looks like, right, as we continue to move. So that's creating a long diagonal spread using a leaps option as a substitute for owning the underlying stock. Yeah, and more room to buy it back if that implied volatility does buy back. So we can create it. And again, that's the great thing about long verticals and long diagonals, is you can create them where you want to do that. Now, did I include a limit target? I didn't, because, in this particular case, nor is this a trade that I would look at defending, Jerry, in this particular case. So let's go back over here to our monitor tab, and here's our AT&T trade. We're going to say, look, I paid $2.76 for it. I'm going to be willing to take that as my maximum theoretical loss. I'm not going to put a stop order on this at 50% of that max theoretical loss. I'm not going to defend that side if this starts to go against me. But what I will potentially do in this particular case would be to roll the short leg. I always have that possibility. I could even roll the long leg, but I can move around that short leg. So if I don't like what's happening, I can move it or close it, right? That's the idea, and I've said this before. I think they said this last week, and it's a conversation that we have. We're coming up in Anaheim next weekend. We're going to be doing the Advanced Options live workshop. And my good friend Kevin Hinks, who is one of the hosts of Fast Market on the Schwab Network, has a great comment. He says, look, one of his first bosses said, you're in the moving business, not the storage business. So we don't want to stay static with this. The idea is, if this doesn't do what we expect it to do, if it's not where we want it to be, move it or close it, right? Adjust the position. Yeah, you could certainly, Martin, roll that one, right? So Paula, the reason I chose this one and it being a little bit lower cost is because, look, our investment in the trade is under that risk limit for some that might be trading smaller accounts. I know Barb Armstrong talks about that a lot. This is also, from a technical perspective, if we look at the chart, It was more the chart setup in terms of the duration of the trend and the fact that we've got that ascending triangle working out from that perspective. So, Kala, that's why I was looking at this versus something else within that, maybe the telco space, right? All right. Let's go back over here to our monitor tab and let's take a look at a couple of these other positions that we have on here. The one that I wanted to look at right here was Broadcom. And staying in the the diagonal spread realm, here's Broadcom. We created a long call diagonal on Broadcom with the long expiration being the 20th of June, the short expiration being the 6th of June. And this spread right now, if we were to close this trade down, right? If we were to right click, create a closing order, if we were to sell this diagonal spread, we can sell this diagonal spread back for $16.55. So let's see whoops, I didn't want to add to the position, but let's see what this has done. So let's go to AVGO. So we created this trade about a week ago. It's continued to move higher. That's doing exactly what we want it to do. So I'm going to go to the Analyze tab for AVGO, and I'm going to do this. I'm going to show all, and I'm going to kind of bring in the positions that I want to see here. So let's take this one off. Let's take our stock position off. And there's our diagonal spread that we created last week, right? We are long the 20 June expiration at the 205 strike. We are short the 225 strike for the 6 June expiration. And here's where the price of the stock is right now. So what I want to do is I want to set my slice to break even. And we're well above at the moment, we're well above where that break even is, right? So the price of the stock currently for AVGO, if we go over here to the chart, is at 232, right? So here's 232, thereabouts. That's where the price of the stock is. We're deep into that in the money position on this trade. It's above our short strike. It's now at that particular point. So here's the thing to think about, right? We're still long this June 20th. Let me get rid of this simulation right there. We're long the June 20th at the 205 strike. We're short the 225. The stock's sitting at 232. We could increase the profitability in this trade. This is what I'm talking about, and being either closing it or moving it. The price of the stock has made a move up. Let's see if we can roll this vertical spread and bring in some additional premium because the price of the stock has gone up. So charts gone higher, implied volatility is moving higher into this earnings announcement. That means that these premiums are going to be a little bit juicier. We're going to bring in a little bit more premium. So what we think that we might see is, again, remember, we bought where we thought the stock was, or where the stock was, and we sold where we thought it was going. It went there. Now we're going to do the same thing. So we're going to go back to the trade tab, right? And we're going to look at rolling. We've got one roll from a time frame perspective that we could accomplish, and then maybe two. So we're going to roll from the 6 June expiration to the 13 June expiration. So we know right now we are short. Let's come down here. We know we are short the 225, which is now in the money. Okay, cool. So we got to buy that one back. It's gotten more expensive. Cool. That's what we wanted it to do. Now we're going to look at rolling that to a short leg here in the 13 June expiration that is a little bit out of the money. So where do we think the price of the stock is going to go from here based on implied volatility? Again, that gives us our target for where we're going to sell the short leg. So about 27 points to the upside. So we think about this, that's 250, 260, maybe? We think this might go up to 260 based on that 27 point up or down. Yeah, so that's about 260, thereabouts. So that's where we're going to look at selling. So we're going to look at rolling from where we are to the 260 strike. It's pretty tight bid-ask spread-wise. So some liquidity here. Remember, rolling's not a magic wand. Rolling doesn't eliminate transaction costs. It simply is a facilitator to allow us to close one leg and open another leg. And it depends on the liquidity in the target expiration and strike. So we're going to roll out to this 23 delta option, and we're going to bring in maybe 390, 395 of premium. So let's do that. I'm going to go back to the trade tab, and we're going to right click on this short leg, and I'm going to create a rolling order. And we're going to roll this out to the next expiration, which is the 13 June. It by default goes to that next expiration, but I'm not going to roll it straight across in terms of the strike price. I'm not going to roll to the 225 strike. I'm going to roll to the 260 strike. And you notice that in this particular case, in order to do that, I'm going to end up having to pay. Now that becomes a problem. So we've got something that we've got to pay attention to here. If I'm going to roll this, but I'm going to pay for it, that's adding to the cost of that long leg. So I want to think, roll it for no cost or roll it for a credit, or else maybe walk away from it, right? So close it down and take our gain and move on. So what we're going to do is we're going to actually come back a little bit here in terms of where we're going to sell that premium, and not all the way out to the 260, which would be the nice target. But what if we were to come down and split that difference? Let's go, instead of the 225 strike, let's go to the 245 strike. And that's still going to cost us to roll it to the 245 strike. Let's roll down to the 240 strike. Still going to cost us. So let's see where our kind of break-even point is. If we go to the 227, and that's not traded, that's frustrating. That's what you've got to pay attention when you roll. So let's see if we've got a 230 strike, and we're doing that for a little bit. The price of the stock's already sitting at 232, so it's already gone up above that. So this is one of those circumstances where you have to pay attention to, right? You've got to pay attention to this. So in this particular case, so yeah, let's see. So let's just think about this, what this looks like in terms of this order before we do this roll. So let's see what we've got to accomplish. And I agree with you, David. So let's look. We're short this one, right? And I'm going to reduce the number of strikes so that we can see this. We're short this one. Let's reduce. I don't need 100 strikes. I don't maybe need 14 strikes. So in order to buy this back, we got to pay. We're going to have to pay $15.50 to buy this back. So we know that we've got to sell an option for more than $15.50. We know that we've got to sell an option for more than $15.50 to accomplish a credit for the roll. Okay. So let's go to our next expiration. And see, that's the problem. We're not able to sell one out here in that out of the money position that gives us that opportunity to take this trade and roll this on. So what we may think about doing is something that we could do, which is roll it from a diagonal into a vertical. So we could go to the 20 June. We know that we're long this if we add our strikes here. Let's add 30 strikes. We know that we're long this one that's deep in the money at the 205 strike. So could we roll? We know that we've got to buy that one back for 15. So could we roll this to, say, for instance, the same one straight across the 225 into this short leg? Now we're rolling this from a diagonal into a vertical. It's going to be a long call vertical, and it's going to be in the money. So that seems to be transaction cost generating. What we may simply do is just close the trade down, because we're not going to get that much more out of it. We're already in the money position, right? So this might be a circumstance where instead of rolling this vertical spread, because we don't have a lot of credit because implied volatility is relatively low, we might just simply close the trade down. Remember what I said? We're not in the storage business, we're in the moving business. So we're going to move it or close it if that circumstance warrants. So we're just going to do this. We're going to create a closing order, and we're going to sell this whole diagonal spread back, and we're going to do it for a $16.35 credit, because we're getting a little bit of premium out of the gain in the long leg. It's gone deeper in the money. It's gotten more expensive, but we got to buy back the short leg here in this particular case. So we're going to do that. We're going to take this trade off and take a small gain in this trade. diagonal spreads are not big. They're not home run hitters, right? In general cases. So we're going to read through this order, make sure that we're aware of all the conditions, all the alerts, and we're going to click on send, and we're going to fire that order off. We're going to close that one down. All right. Now, the next one that I want to do here really quickly is I want to go back over here to my monitor tab, and this is the one that I wanted to pay attention to. This is Delta Airlines, because a different kind of circumstance is happening here on Delta. We did two different trades on Delta last week. We did a short vertical spread, and we did a long vertical spread. We were bullish on both. So we did a short put vertical spread to take advantage of that bullish movement, and we did a long vertical spread to take advantage of that bullish movement. Notice what's going on here right now. The long vertical spread, where we bought the 47 call and we sold the 50 call, at the moment is kind of sitting for about exactly what we paid for it. So let's look at the chart really quickly here. Let's go to Delta, DAL. And you can see that Delta's kind of come back a little bit here, right? So what that means is it's put our vertical spread, our long vertical spread, slightly more out of the money. We need some directional movement here, right? So what could we do? Implied volatility has gone up. That's good. We want to see that happening. We could roll this trade and adjust it a little bit. We've got a little bit of time that we could roll this long vertical spread and adjust it, or we could roll it into a diagonal, perhaps, if we wanted to. That might be an opportunity if we've got some premium in that expiration. So we're long the 13 June. Let's go to the trade tab here for Delta and let's see what we've got. Here's our 13 June. So we could roll this from this one that expires a little bit further out in time. So we could buy this one back, the 50 strike. We could buy that back for $1.60. And we could roll to a shorter period of time right here. And let's see how much premium we could bring in if we were to roll, say, for instance. See, we're not going to bring in as much or enough, perhaps. Let's see, we're going to roll that back. We got to buy that back for, what did we say? $1.63. We could potentially. We're long the 47. We can shrink this spread a little bit. We could roll this to a diagonal by selling, say, for instance, the 49. So just kind of bringing this back, we're still keeping it as a spread. It's still going to be a diagonal, still has that expectation, just hasn't have to go as far, and we're bringing in a little bit of credit. So let's see what we could do. We could either close this trade down, but we're bringing in a little bit more credit because we're going a little bit further, a little bit closer to the at the money strike. So we're shrinking the width of the spread down. But wait a second, where are we? We are long the 47. So we're still okay in this particular case. So here's what I'm going to do. I'm going to right click and we're going to create a rolling order. And I know that what I'm going to do is I'm going to buy back the one that I'm short and I'm going to sell another one. That means I'm going to be doing this calendar right here. But what we're going to do is we're actually going to go a little bit shorter in expiration instead of a little bit longer, and we're going to change the strike price. So we're going to change the strike price that we're going to go short, and we're going to sell the 49. And we're going to do that for even, basically, or a little bit of a credit here, which is okay. It just gives us another opportunity to perhaps gain some additional premium. This one's going to decay away a little bit faster. So I'm going to click on confirm and send, read through this order, make sure that I'm aware of any alerts, and I'm going to go ahead and click on send. And what we did is we rolled one of those back. Now we've got a longer dated long leg. We turned this vertical spread into a diagonal. Wow, interesting. So now the trade, if we go to the Analyze tab, the trade that we had on here, let me do this. Let's go hide simulations. Let's take that one off. Let's take those two off. And now here's our diagonal spread that we have. And we've given it a little bit of an opportunity to maybe kind of stay within that range of profitability so we can continue to look for that trade. So guys, we've done some cool stuff here in adjusting vertical spreads and diagonal spreads. putting on a couple of trades with a longer dated long leg, and then we kind of adjusted our long vertical spread into a long diagonal, but we brought our expiration down a little bit on the short leg. So that gives us another opportunity to roll to a vertical spread at a later date. The great thing about long vertical spreads, long diagonal spreads, is that you can do whatever you want with them, right? They are a very flexible strategy. Just pay attention to where the risk is, know what your risk in the spread is, know what your risk in terms of assignment is, and you have a directional price, time, and volatility expectation for your trade. Guys, thanks very much for letting me show this stuff to you and talk about this. Again, my good friend Brent Moore is out there. If you want to learn more about this, type in long diagonal, and you're going to get some great information about diagonal spreads, how to build a long vertical spread, how to adjust them, rolling long diagonals. We've got lots of different webcasts that you can use. My thanks to all of you. Follow us on X at Ben Watson CS, at Brent Moore CS. Remember to click on subscribe and like, and we will see you guys again next week. Take care, everybody. Bye-bye.